What if I told you there's a way to save thousands of dollars on your home purchase without lowering the price, without bidding wars, and without skipping important inspections? It's called seller credits. And if used correctly, it can completely change the math on your deal in your favor. So in this video, I will show you how to use seller credits like a pro, no matter what loan type you're using. But it's not a one-size-fits-all strategy, so stick to the end and I'll let you know exactly what to do in your particular situation. Seller credits are also called seller concessions. Essentially what they are is the seller is agreeing to pay for some of your closing costs, sometimes all of your closing costs. Think about those fees that we don't really think about when you're buying a house. Title fees, escrow fees, property taxes, lender fees, interest rate buy downs, those types of fees, these seller credits can pay for or help you pay for. It's also a way to roll in the closing costs into your deal, just depending on how you structure it. The important thing to remember is that the seller isn't actually handing you cash. What they're doing is they are agreeing to take a smaller profit on their sale in order to keep the sale moving forward. So if you negotiate this in a fair and smart way, it can be a win-win for everybody. So seller credits can be used to pay for closing costs. The closing costs that we are talking about are non-recurring closing costs, the one-time fees you pay for when you buy a house. These are going to be title fees, escrow fees, underwriting fees, lender fees, property taxes, homeowners insurance. All of these items have to be paid for when you're buying the house up front. So these seller credits can help pay for those. They can also help you buy down your interest rate, either in a permanent fashion or in a temporary fashion. Sometimes the seller credits are used for repairs. If your home inspection reveals that there are some items that you want to have fixed before you take possession of the house, then you can negotiate a seller credit, and then that way you'll have enough money left over after you purchase the home to take care of those items. Here's the catch with seller credits. They cannot be used for your down payment. They can only be used for closing costs. The down payment still has to come directly from the buyer. And you also can't use seller credits to pay off your debt to qualify. Each loan type has its rules as to how much of a seller credit they can give. So here's a quick breakdown of how that works. For conventional loans, if you put less than 10% down, the maximum seller credit that can be utilized is 3% of purchase price. If you put down 10 to 25%, the max seller credit is 6% of the purchase price. If you put down 25% or more, then the maximum seller credit is 9% of the purchase price on conventional loans. For FHA loans, it's pretty simple. It's 6% across the board. VA loans are also simple. It's 4% across the board. And USDA is typically up to about 6%. Keep in mind, if you get too much credit or you negotiate for too big of a credit that your loan type won't allow, that credit will be lost. So in those cases, when you're able to negotiate more than you actually are able to use, then what you would do is you would reduce the purchase price on the home. Since they've already agreed to make less profit anyways, it's all the same to the seller. Structuring seller credits strategically is very important, and this is where the magic happens. You have to make sure that you position the offer in a way that's favorable for the seller as well, not just you. If there's a house for sale for $500,000 and you need $10,000 for your closing costs, a smart way to negotiate that would be to offer $500,000 and then the seller credit for $10,000, rather than asking for the price reduction at $490,000, because you're now able to utilize that seller credit to do things like buy down your interest rate or just lower your out-of-pocket expense for all the closing costs that you have to pay. And sometimes what you can do, for example, on that same house, the $500,000 house, if the seller does not want to take a loss, but you love this home, then what you do is you can increase the purchase price and then build in the seller credit that way. So for example, you would be building in $10,000 into the purchase price at $510,000. The seller's still gonna net their $500,000, so they're happy, and then you're happy because you don't have to come in with an additional $10,000 for closing. Sometimes a small increase in the purchase price has a minimal impact on your monthly payment, but it has a great impact on your cash to close. So make sure you talk to your lender about seller credits. If it's a strategy that they're bringing up, it is something that is more common in today's market versus a couple of years ago. So it is something that I am personally seeing on most of our deals, some sort of seller credit for closing costs. So if you have questions about that, talk to your lender, or you can always reach out to me. So if used correctly, seller credits are one of the most powerful tools that a buyer can use, especially if you're a first-time home buyer. Today's high-cost market, everything's expensive, so every penny helps. If this video helped clear up any confusion, do me a favor and hit the like and subscribe buttons below. And if you'd like to discuss the different loan types that you may qualify for, and you want to set up a personal Zoom call with me, use the link in the description.